Over 25 million Americans currently have a personal loan with a total balance reaching over $276 billion. In the last 12 months, those numbers are up nearly 8%. It's no big insight to say that Americans are familiar with credit. People borrow for a lot of different reasons, just buying stuff, vacations, job loss, medical debt, education, home improvement, family planning. The list goes on and on. As comfortable as we are about borrowing money in this country, we still generally don't understand how the process works. How do companies decide whether to approve or deny me? How do they decide how much to offer me? What drives the interest rate? Today, we'll explore what lending looks like from a lender's point of view. My guest today is David Peterson. He has over 20 years experience in financial services. He has managed teams that designed the algorithms that approve applicants, determine how much to lend them, and at what interest rate. He served as chief credit officer for a lender for 7 years. So he had a front row seat to decisions about how lenders work and the changes that have been happening in lending over the last several years. Full disclosure, David and I go way back. He and I worked for the same lender for nearly 10 years. David, thanks for being with us today.
Hey, thanks for having me, Jonathan, and glad to catch up.
So I want to jump right into the way lenders think. Over the years, I've heard people complain about not being approved even though they had a decent credit score, or they didn't understand why they were offered the interest rate that they were offered. So I want to explore a little bit about what happens on the lender's side when someone actually applies for a loan. And let's start with that information. What kind of information does a lender actually need in order to make a decision on whether to lend someone money?
Yeah, that's a great question, Jonathan. I mean, it's multifaceted, and it depends on, in a lot of ways, your credit score. And so if you're in the prime scores, and these are scores with very good credit backgrounds, let's call it 750 and above, maybe even higher than that, a lot of times lenders will just rely on a FICO score or a Vantage score, which is just an all-encompassing credit score that says this person's really good. Now, some might also look at, do you have the money to afford this loan? Like, they want to make sure you have a job and you have stability and you've lived in your apartment or condo or house for a certain period of time, but they're looking for stability. Now, from an alternative lending perspective, you can find very different things where consumers may have their credit scores don't look as good. And so you're looking for more information to be able to understand, can this customer afford this? Can they pay it back? And also, do they have the willingness to pay it back? For us, I will tell you, we, meaning us being my last stop at Elevate looked at a lot of things because they were an online lender that never met a customer face to face. So there's an aspect of understanding, is this person who they really say they are? Which I think is a really important piece, and you want to take that off the table. But then you're looking at alternative bureaus and alternative information that might say, hey, they've taken 3 or 4 loans in the last year and they've paid these back, even though they might have a bankruptcy on their credit, or they may have different troubles with other loans. And you're really trying to piece together all this information. I can tell you, for us, it was, we wanted to eliminate fraud. We wanted to make sure that they could afford the loan and had the ability to repay this loan, that they had some history of credit that said, yes, they could do it. And then the other thing we looked at is that there's also regulatory requirements to things called KYC, MLA, OFAC, and FACTA. These are things I would tell you, review on your own time if you're interested, but there are regulations to make sure that we meet a certain standard for all customers, and the government puts in place. So that's the other piece that we're always checking to make sure. But there is one, and I'm sure we'll get into it in a second, but things like bank transaction data, which is also an interesting piece, because you might trust your credit scores that you took loans out, but for some people, the credit scores don't look good. So we use bank transaction data, and this is looking at a customer's checking account data to see, do they spend their money responsibly? Are they managing their checking account? Because that is a statement of credit just as much as, hey, I borrowed money once and I paid it back, or I'm making payments on time. So there's a lot of ways. It depends on the type of lender, depends on who's being lent to, and depends honestly on the availability of the data. And all those things come together, and it varies.
For what, last 20 years, we've just been beat into us this idea that the credit score is everything. What's your credit score? What's your credit score? What's your credit score? Right? I mean, Credit Karma and have made billion-dollar businesses around this idea of making sure that everybody understands it. But what you're telling me is that the credit score may be relevant for some lenders, but a lot of other lenders may look at it or may not even look at it at all.
Yeah, I think that is accurate. I would say, as you look at the prime lenders, again, you can lean on a FICO score or a Vantage score. For us, and most lenders, I would say, have built their own credit scores. They're not leaning on just a FICO and a Vantage, and there's a lot of different varying factors that may go into it. But you brought up Credit Karma, and I think it's interesting. If you don't realize it, that's where they've now integrated a portal for taxes, and they've integrated a portal for insurance. And there's a lot of varying ways they can use it to look at it and say, hey, I can get you a better rate on your insurance, or I can help you with your taxes. But it also starts to put this, and I like this term, this mosaic of a customer, where you can take all these pieces and parts and come up with a fuller picture that one score doesn't represent an entire customer. There's a lot of factors that go into it. So all that data is meaningful data in its own right.
When people say, just check your rate, they come in, they get a pre-approval. What's going on between that point and the point at which they're pulling a full credit report? How different are those two moments? Because I know some people complain, hey, I got pre-approved and then I was denied when I actually went through the application, and they feel like it was a bait and switch. Yeah. What is actually going on between those 2 points?
Yeah, it's a really good question. So there is, in the new world of credit bureaus, there's all kinds of availability of information that can be shared with lenders. And what that means is, take direct mail, for example, might be one. All that stuff you get in the mail says you're pre-approved for whatever amount at this rate, whatever it may be. Well, lenders can go to the bureaus and say, I think I want to run marketing campaigns to a subset of the customers in the universe. And I'm looking for customers that meet certain criteria. Now, what they will do is the bureaus can share that information with lenders, but it's all anonymized. So I don't know that David Peterson's credit is this. I don't know Jonathan Walker's credit is this, but I have their information. It's just anonymized. Now I get to sift through it. And in a lot of cases, we've done it where you're getting millions and millions of records or customers, and you're trying to find the right subset. Let's say we're trying to market to 1 million customers. Well, if they meet certain criteria, we might say, yep, this is who we want to pre-approve, and we will send those offers to those consumers. Now, that term pre-approval should be met and it's ambiguous. There's no real definition on how many of those offers have to be completed, but you should be at a certain rate where when I offer this to a consumer, 80% of the time or more when you're pre-approved, you should be receiving that offer and getting the offer. Now, the part that will get you is that you still have to make sure that I send the offer to the right place. Because what if it's not the right person? When I pulled that information from a bureau, their information can change over time. What if all of a sudden in the last 2 months since I sent that offer, you lost your job, you've defaulted on 2 loans, and you're in bankruptcy? Well, what I sent you this offer was pertaining to certain terms, and now the world looks different. So things can shift in that. But ultimately, what lenders are doing is they're using the credit bureau information, and the bureaus are anonymizing it to protect the consumers. But they also realize the consumers want those offers. They might be a good opportunity. These marketing things, while some people might look at it and say, man, I'm just getting trash in a mailbox, or I'm getting junk in an email box, or I'm being presented something digitally, it's still an opportunity to put something that should be better than what you're dealing with today, or fits a need that you're looking for. And so you utilize that information to put the best offers in front of them. And again, when you say pre-approved and pre-qualified, they should be, based on the information that was at hand, assuming everything holds, it should be good, and you should get the terms that they're offering.
I think that's really something that people really need to understand, especially about those the offers in the mail. Because if we think about a credit file, if I am late on paying my bill and I'm reported 30 days late, well, I'm 30 days late before it's reported, and then it hits the credit bureau, and then you see the information, and then the mail goes out. From the moment I'm actually kind of in the moment before I'm in financial distress to the moment where I get a pre-approved offer in the mail can sometimes be a couple of months in some cases.
That's right. So it's a great segue to some degree when we talk about checking account data and bank transaction data. When you go overdraft in your checking account, I know it the next day. I can see it then and there. And you just pointed out, Jonathan, I mean, I got 30 days to pay my statement. If I don't pay my statement, then it's going to be processed. And most lenders are going to give you 10 to 15 days grace period. Then once you get a full 30 days later, that's when they're going to report it to the credit bureau. And there's no guarantee that file is going that day to the credit bureau. And there's no guarantee when the credit bureau is going to actually run their process. So there's a possibility that if you go 30 days past due, it could be 5 months before it shows up. And I think the most real world example right now is student loans. We're seeing student loan delinquencies where for 3, 4, 5, even 6 years, the government said, hey, you have a state of execution. You don't have to pay your student loan if you don't want. Now, there's categories of who can and can't. But let's be clear. I think it was end of August, certain customers were required to start paying their student loans. But student loan delinquency doesn't get reported to bureaus until they're 90 days delinquent. So now you have to wait. You start the clock on August 30th. You have 90 days to wait. Then it's got to get to the bureaus. We didn't know if people were really not paying their student loans or paying them for almost 5 months after the point where they were supposed to start. And so that's a question. Well, how do I use that data? How do I use it to make a decision? And it's difficult because you're not always playing with the most accurate and the most up-to-date information. It's all fluid in that sense.
Well, and I think that's what's so powerful about bank data. And it's a two-edged sword. I think most people right now, it feels pretty invasive. You want to look at what? But it cuts both ways, because what it does give is a very clear view of what my finances are right now. Correct. Do you find that a lot of people, do people drop out when you ask for bank data these days, or is it becoming much more common?
So we started using the adoption of bank transaction data probably 2014, 15 was when we were one of the first ones to really step into it. At that point, now, before we even get to the numbers, I think you have to explain what's happening. For a lot of this bank transaction data, if I want access to your checking account information, it requires you to go to a company. It could be Plaid, Finicity, Ninja Edge. There's all kinds of companies that do this, MX, that provide a screen on the application that says, use your username and password that you would use at your bank. So whether it's Citi, Wells Fargo, Chase, doesn't matter. You're entering your username credentials. A lot of customers say, whoa, no, I'm not giving you my username. I don't know what's happening there. And it's a real issue. But for some reason, take the biggest adoption point. Every time you sign up for a Venmo and PayPal account, you're entering your username and password and entering your credentials. And for some reason, when you go to Venmo, it's like, cool, I don't mind that. But when you ask it for a loan, it's like, whoa, I don't know if I like this. So the adoption rate depends. It depends on the reputation of the lender that's asking it. It depends on which product is asking the tool that you're using. So is it MX or Plaid, whatever? All of them have different user features. But to continue the story ahead, I'd say 2015, you were lucky if you got 20% of the customers to give you that data. Now you're seeing an adoption of almost 80% of customers being willing to give it to you, depending on the tool, depending on what you're asking. And once you're actually onboarded, we saw almost a repeat borrower willing to give it to us 95% of the time in Connect. So those numbers have changed quite a bit, and it's meaningful. If you can get it on 80 to 90% of the consumers, that is interesting data that we want to know and we would want to use to make the best decision possible.
When a lender is making a decision, especially online, that decision 80, 90% of the time is happening within seconds, like 10 seconds, less than 10 seconds.
Yeah.
But what's interesting to me is we think of our credit report and we think of it as this piece of paper with a lot of information on it. It's a very structured data set. Bank data feels like it's a little unusual. I mean, it's not like anybody is sitting behind the scenes and in 10 seconds are looking at all this information.
Yeah.
So what is actually happening in a lender that allows it to consume this kind of data and within 10 seconds tell you, I'm comfortable giving you $30,000 or I'm not comfortable giving you $30,000?
Yeah, so you throw out the 10 seconds, and I think let's separate that. I think some bureaus have standardized the data where you can get the data in milliseconds. I mean, it's instant. You ask for the data, and there's technology going on behind the scenes that APIs, exchange data, get data, process data, give it back, and it's instantaneous. I'd say bank transaction data is one. As you think about it, how many transactions do you have in a month? I mean, some may be 3 or 4. It may just be deposits because they use credit cards more often. If you use your checking account, you could have 90 to 100 transactions at the gas station for meals, for groceries, for whatever, electrical bill. And how do you process those things? And then on top of that, there's subcategories that say, well, where was this transaction taking place? Was it on the corner in Timbuktu, or was it in New York City in Times Square?
Was it the Starbucks on the street or in the casino?
Correct. And I would tell you that is an interesting one. If I see somebody taking all of their paycheck out at an ATM in the casino on a Friday night on payday, you can probably assume the risk level. I think most of those people probably would say, but I won all my money that day. That's not for me to decide. I would tell you those consumers are probably a little bit higher risk. And so you asked, how do you process all that data? How do you do it? Realistically, you can't get it in milliseconds. They're using APIs, and the most of the lenders and banks have now gotten to a point where they realize bank transaction data belongs to the consumer. It doesn't belong to the bank. And so a consumer, if they request it, we need to be able to hand that over to help them get loans and offers or whatever it may be. With APIs, you can do that in, call it 10 to 20 seconds now. It's gotten pretty efficient, but it's not going to be instantaneous the way some of the credit bureaus would be. And then on top of that, there is still the world where they have to go green scrape the statements off of your account and pull bit by bit, byte by byte, turn it into real data that could take up to a minute to 2 minutes. So on one hand, you have the expediency of making a decision where you want to be instant. You'd love to do that. Our business was always, we wanted to answer you quickly and give you an answer right then and there. But how do you do that information, and then how do you process it? That's in the secret sauce where I would say there's a number of companies who have worked really hard to build bureaus that are built off of that data and have structured it in an environment similar to an Experian, TransUnion, Equifax, and companies like Prism, companies like Ninja Edge, who have taken that data. Score My Cash is another one. Take the payload and summarize it so that a lender can use those key points. Now, there's some sophisticated lenders, and we've done it, where we build that structure and can process it really fast, but it's a lot of time investment to do that, and it just depends lender to lender what their choice is. But you can get it fairly quickly. The availability has gone way up, and how you want to use it, you can use it for so many different purposes, but ideally to say yes to customers.
You'd mentioned earlier in the conversation, and I heard you talk years ago about this idea of first-person fraud, third-person fraud, and whatnot. And I think what we often forget or don't realize is the bank data also can help on the fraud side, right? How long has the bank account been open? Is it connected to the same name as the person that is pulling the, asking for the loan?
No, that's right. I mean, look, for lenders like Elevate who don't meet the consumer face to face, to see, hey, Joe Smith is applying, but Jennifer Wright over here is on the checking account, something doesn't add up. And realistically, if you think about it, if I'm a fraudster, the one thing I need to have to be able to really defraud you is the checking account, because that's where the money's going. If it actually goes to the right consumer, then I haven't defrauded you. I need the money to go somewhere else. So it's a heck of a fraud tool to prevent funds going to the wrong spot, for sure. And then, yeah, there's other things on the first party fraud side where, hey, I can go see they've taken 10 loans in the last week and a half back to the bureaus. No statements have been made, but I can see they haven't paid. Well, let's say it's over the last month. I can see they've already had a statement and they haven't paid any of these loans. That tells you something about their intention with this loan, that they're really taking it because what I would call busting out and not being able to pay this loan back. They're taking as much money as they can while their credit's in good standing. And I don't want to take that risk at that point in time. That's something you could see in the checking account.
First party fraud is, I am who I am, but I have no intention of ever paying you back.
Correct.
And third party fraud is, I am pretending to be someone else to get the loan, and you'll never hear from either one of us again.
That's well said. And I think in the new world with AI and other tools out there, the third party fraud is scary. And I think every lender, quite frankly, I mean, it's, everybody wants to do their secret sauce. Everybody wants to be a little bit different, but this is one area where all lenders should really work together to eliminate as much of the third party fraud as possible, because nobody wins. We all lose. But the first party fraud is where it becomes more ambiguous and where it's a little bit harder, because customers go in and out. And even some of the customers, they might be doing perfectly fine. Then they hit this rut and they're stuck. And so they act in their own self-interests. And the lenders have to figure out who's doing that to avoid those missteps and losing money and all that.
Yeah, years ago, I interviewed someone, and I'm not sure it rises to the level of first party fraud, but it's awfully close, where I interviewed someone and I asked them why they took out a loan. And they said, well, I took out a loan because I needed to pay the attorney for my bankruptcy. The person knew that within moments of taking out the loan, they would never be paying that loan back.
Yeah, no, that's exactly right. I mean, the more you can eliminate that, the better. And not only that, when you talk about pricing and rates and things like that, that's what you're building in. If we can lower fraud, if we can eliminate the waste, it should allow customers and lenders really to get better rates. But ultimately, you're usually underwriting the entire portfolio, not just the individual consumer. And I think that's a key point. And you're trying to make sure that we're getting a certain return on investment. The more that you can eliminate that, the less you have to spend on different things, and you can run a more efficient business.
I want to talk a little bit more about that, because there is this perception that lenders just take my money. I can understand how people get to that conclusion. When I buy a bag of potato chips, I go home with a physical item, right? I go home with chips. I can complain that they are too expensive, but at the end of the day, I have something. But lending is different. When I borrow money, I'm given money and I'm giving money back. I don't have anything physical to show for it. And so it's really common for people to complain that, the lender's taking advantage of me, or, they're sitting on a big pile of money and they're just using that money to exploit people who don't have money. And there isn't this understanding of what the lender is actually doing that might cost money to them, right? They just think it's free money. Any interest rate is free money. So I want to walk through a little bit about the business of lending. Yep. Unlike Frito-Lay, Frito-Lay has, you got to buy potatoes, you got to buy oil, you got to buy bags, you got to pay someone to ship the stuff. What are those things for a lender that the lender actually has to pay for that we don't often see, because we just see that interest rate and think we're just being taken advantage of?
Yep. So you'll walk through a P&L in some ways, the profit and loss statement. So your first thing's revenue, and that's what the customer's seeing is, they just must be making money. Revenue is what you bring in, and that could be principal repayment or interest. So as you pay down the loan and the interest, that's your revenue. But then you get down to the next levels. So first thing, some people don't pay you back. There's going to be losses. And just like if it's a bag of chips, there's spoilage. It just doesn't get sold off the shelf. You've got to manage the losses. So that takes a cut out of it. different for different lenders, different for different credit tranches. But there is something that if I make $100, let's just for now say I'm going to lose $40. Okay. So now I'm down to $60 in profit. So then the next question would be, well, the customers have to find us. How do we go find the customer to tell them about us? And you talked about pre-approved offers, pre-qualified offers. Well, there's a cost in interacting with Credit Karma, sending mail, being digitally out there. It's not all word of mouth. I wish it was, but it isn't. So you're competing for consumers. Let's say that costs us, I don't know, $10 to go pay for that. So now we're down to $70 left. The next step, you might have transaction costs. So it costs money to have a call center. When you call in and say, hey, I'm having troubles with my statement, how do I do this? Well, you have to pay those individuals to be online, ready to go. You have to pay for ACH transactions. Every time you make a payment, well, Visa, MasterCard, some ACH processor, they're taking money. Let's say that costs another $5 that's in there. So now we're down to, say, $60. Let's just say that in profit. Well, now there's another piece, which is this money we have to borrow too. A lender has to borrow money to offer money. And I don't know what the rate would be, but depending on the lender, it could be really low. Like banks that already have deposits, they have the money and they're spending far less in interest. But a consumer lender conceivably could have interest rate costs of 10, 15, 20%, depending on who they are. So right then and there, let's say on the money that was borrowed, that $100 we got, there's probably another $20 that the consumer, that the lender is paying interest on that takes some money away. So now you're down to $40 left over. Now the last $40, maybe there's still people who have to work to say yes to the consumer. Just like any other business, we have accountants, we have people who develop the products, we have technologists who build the websites and the apps and all those different things. Gut check, let's say we spend $20 on all those people to be there, including our building or our office space, whatever it may be, and the computers and all those things. They all cost something. Let's say that takes another $20. So now you've taken $100 that sounds like, oh, the lender's just making all the money, and $80 are gone, just completely gone. And then you're left with $20 that maybe that's profit. Maybe it's reinvestment in the next product that we can help more consumers. That could be whatever it is. And that you can argue, hey, are they taking too much? Well, some people might only take $5. Some might take $20. And realistically, there's also businesses that don't do well that aren't earning anything. And so where does that level come? That's the question where you can debate, are they making too much money or too little money? That's a fair point. But the rest, realistically, you're tuning your business to those things. And an efficient business has to find a way to minimize losses, get as much reach as possible for a certain amount of marketing spend. They have to be efficient with call centers and things like that, and efficient with their employees and their salaries. So all that plays a part. Hopefully I didn't sound like an accountant there, but hopefully that waterfall sort of makes sense on where the money goes, that it's not just straight to, say, my pocket, for example.
I spoke with someone years ago and they kind of complained, hey, you guys charge higher interest rates. Why don't you lower the interest rate? And I said, well, we could. That would make us a prime lender. Right. I mean, it's kind of, there's this direct relationship between the losses that you have because people just struggle to repay and not. And one of the things that is so hard for people to understand is that even with people that have, say, a FICO score of, say, 580, which everybody would agree is not a great FICO score, still 80% of those people will repay the loan. They will have no problem. But if 20% don't, that becomes a huge hole. And so it's talk a little bit about the challenge that a lender has in predicting the future, right? You want to predict the future of whether Jonathan will pay you back, but you can't know for sure whether Jonathan can, but you know that if there's 100 Jonathans 20 of them may not. And how hard is it to find those 20?
Yeah, that is, you took the words out of my mouth. That we usually play in cohorts or vintages, and in those vintages, you're trying to find 100 Jonathans, not one Jonathan. But ultimately, that's what you're trying to figure out is how can I, back to that credit bureau data that we talked about, or the checking account data, or the fraud. That's why fraud is such a big deal for me. If you can eliminate fraud, suddenly I have more Jonathans that are paying. That's a good thing. And that means I could lower my interest because my losses go down. And just to tie it to the analogy, interest, when I say revenue or the top line that starts with that $100, that's interest for the most part. That's really what you're talking about. So if you shrink the top of the waterfall, the rest of them have to shrink too. And so you have to be more efficient with all these things. But from an underwriting perspective, and that's probably more my background, how do you find more Jonathans? You use that bureau data and you tune what we call our secret sauce to be better than the competition, to find more of the good customers. And I think that's where, when we talk about customers like, or not lenders, but Credit Karma, for example, they're gaining more information about the consumer. And as they gain more information, they're able to share it with lenders. And those lenders are in a situation where they can compete more. And when they can compete more and you can garner 3, 4, 5 offers, you're more likely going to be able to shop and get better offers. And at that point, it forces all the lenders, if they want to actually do business, they've got to lower their rates too. And then, but in doing that, that $20 we said we made might go down to 10 or 5 or 1. And that makes the whole business more compressed. So, but how do you do it? It's ultimately being more efficient in your business model. And then from the credit models, using all that data as best you can to get an edge on other lenders so that you can offer better rates.
It's all about predicting the future, right?
Yeah.
If if I'm a lender, I am trying to predict the future, and we all know how hard that can be, right?
Look at the economy, look at the geopolitical environment. We don't know what's going to happen day to day, and that has an impact. I mean, let's talk about our consumer right now. If the barrel of oil goes above $100, which it is, and it wasn't there a week ago, now the consumer's at the pump and they're paying $20 more. Well, if they're paying $20 more, let's say it three times a month, or groceries are costing 10 to 20% higher, and you buy $100 of groceries each week, now it's $110. You've now lost $100 to $200, all because of something outside of their control. So when you talk about controlling for the future, we talked at the outset, lenders may look to see, have you lived in the same place for 2 years? Have you had the same job for 2 years? Hey, that shows stability, and that usually is a big thumbs up. But to know if you're going to afford the loan, there's outside factors that have nothing to do with the consumer. And this could be really good consumers that are getting by day to day, and all of a sudden they get squeezed. We're supposed to predict that in these models, and it's difficult because you don't know and you can't predict the future. And I will tell you right now, if I could predict the future, I wouldn't be doing what I'm doing right now. I would, of course, be on your podcast, but I wouldn't be predicting the credit scores. It's a difficult thing to do.
Now, this may be a little bit a tougher question for you to answer because you're so focused kind of on the behind the scenes side of things, but do you have any advice to a consumer, someone who's looking for a loan, on how to be a better borrower, how to get the better rates? Are there any tricks of the trade that you can share with people?
Yeah, I do think the Credit Karmas, the lending trees, those have created a open, efficient market where lenders have to compete. I think that's one thing. Be willing to shop. I think there was a old belief, and it's changed now, where if you had too many inquiries and if you applied for too many loans, you could get in trouble and it would hurt your credit score. There's now the world of soft pulls, which, without getting into the intricacies, it allows consumers to shop and it allows consumers to look for loans in a period of time and still hold their credit score where it won't hurt them. And I think that's where the Credit Karmas and lending trees really provide that opportunity. So always shopping is a good idea. I would tell you, don't prioritize one loan. I know there's always pay down the higher interest rate loans and don't worry about the rest. Always make the minimum payments on your loans. The more you can do that, it will help your credit score and it will do better. I would tell you one of the things that Elevate did that with their partner banks, they always reported to credit bureaus. And I think that's an important part of things is not all lenders report to credit bureaus. So you may be paying and doing well, and it's not reflected in your credit score. And that's something that I think is important. Always look to see, is that lender reporting to credit bureaus? I mean, now if you're a first party fraud, you probably wouldn't want to. But if you're trying to help your credit score, find lenders that are reputable like that. And then I just think there are some bad actors out there. Always look at the Better Business Bureau and some of those things. I think there's a lot of posts and comments on websites. Go to the shopping sites and make sure that you're dealing with lenders that are doing the right things. And I think the internet has created a nice, efficient market where if you do a little bit of homework, they could tell you who to avoid and then who you can trust.
One of the most powerful ways of knowing whether you're dealing with at least a responsible lender, regardless of kind of their policies, is how clear they are with their policies. If you can't find out what their rates might be, or whether they even charge any late fees, or if you can't learn any of that stuff, that's my first red flag that if they don't want you to know something, that's probably a bad sign.
I agree. And I can speak on your behalf. I mean, that was one of the biggest things that you were an advocate for in our business, and saying, hey, first off, make sure we're doing the right practices. But two, also don't bury it in legalese. Everybody has those terms and conditions. I'm sure it's somewhere in there and you can read that, but most people don't want to read it. I think it's important when a website says no fees, like that tells you something. And I think that's important to find the lenders that are going to be transparent and honest about how they conduct their business. I always think that's important.
David, I want to thank you for your time. This has been really insightful. I think people will find it very interesting, especially because I think it demystifies a lot of it. I think it maybe helps people realize that lenders are not necessarily evil. They're business people who are just trying to figure it out and trying to provide a service, and some of them are better than others.
Agreed.